Hello, everybody. Welcome to the National Real Estate Post. Frank Gray here with our good friend Barry Habib once again. Before we get started, just want to make mention of the fact that if you're a loan originator and you're thinking, maybe I want to move, maybe I want to look at another company, got to take a look at Movement, right? If you're not, just stay there. But if you're thinking of making a move, look at Movement. They got a 671. That means they start their deals in underwriting 6 hours, then 7 days in processing, then a one-day close, and they stick to it, and they live up to their reputation with that. Everybody loves them. So click the banner you see here on the screen over on your right if you would like to talk to them, or there's a link up above on Facebook. How you doing, Barry?
I'm great, man. How are you?
I'm doing good, man. You know, the last time we got together, you were saying, hey, man, you know, we might see rates bumping up a little bit here, and they did. Why don't you tell us a little bit about what went on there? But then there's the news article that I just saw today that I wanted to talk about. We'll segue right into that. So what's up?
So first of all, yeah, rates moved up a little bit. They're at an important level right now. If we look at the 10-year, just it's easy to kind of use that as a demarcation point. That 2.385 level we talked about was troublesome. We did break above it, and then, boy, it really kind of took off after that point. But now we've seen a little bit of a comeback. We thought and we said, we told our subscribers, we think it will come back to retest that 2.385%. Sure enough, it has. It's actually broken a tiny bit beneath that. So we're at an important level right now. Let's watch that. A move under that would be pretty good. The driving factor that we just saw there was that some news coming out saying that the tax reform that everybody's looking at, which is important, perhaps isn't going to be a one-shot deal. It will take years to implement. So that's kind of like the inside scoop there. And based upon that, the markets did not like it as much as far as the stock market goes. That money flew into the bond market. Okay. And it's exciting news. I think on Thursday, by the way, I know you mentioned the Fed. We're going to get a new Fed chair in February. It will not be Janet Yellen, and I think it's going to be Jerome Powell. So he's kind of a dub. He's kind of along the same lines, maybe not quite as dovish as Yellen, but I think he will be a market-friendly choice, and I think that's going to be announced Thursday. So look for that.
Okay, well, that's a perfect segue into what I saw today, and it was a Housing Wire article that said, doesn't matter who the Fed chair is, look for 4 rate hikes in 2018. What do you think about that?
I think it always matters who the Fed chair is. So I would disagree in that it doesn't matter. I think that the Fed chair has a tremendous amount of sway. You're looking at the Fed chair, the vice Fed chair, who now with Stanley Fischer vacant, the Fed's importance is even greater. And then typically the New York Fed chair, which is Dudley, and that's going to be an important one as well. So the voting members then would also have sway, not quite as high, but they're the next level, and then the non-voting members. So I think it's important where you stand in the Fed, as well as, of course, most importantly, who the Fed chair is. And I think if Powell is the Fed chair, who I believe is going to be the Fed chair, you'll probably see a lot of similarities with Janet Yellen being dovish. Now, does that guarantee 4 rate hikes? I think that's hard to say. Now, we know that the Fed has planned for a rate hike in December. That's done. That's in the books. Consider that a done deal.
Sure.
3 more next year is possible, but you know, it's so funny. The Fed has been awful at forecasting how many rate hikes that they would do. So they have yet to be accurate in this. So I wouldn't put my money on it. But it's plausible. Let's put it that way. So inflation is still very mild. If you take a look at just the most recent numbers that we got on the PCE, the personal consumption expenditure, that's what the Fed looks at. You know, core rate's 1.3%. They're trying to get 2%. And now they've already begun. They're going to start draining a lot of liquidity. It's not just the U.S. You know, so we're going to be cutting back on our reinvestment of mortgage-backed securities and treasuries. And the ECB just announced they're going to cut back, instead of $60 billion a month in buying, they're going to cut that back to $30 billion. Still a lot.
Yeah.
But now combine the two, and you're draining about $1 trillion of liquidity. I think that the markets, the Fed, will have more of a wait-and-see attitude before banking on these hikes. Now, this is coming at a time, Frank, where this is one of the most expensive stock markets in history, and one of the longest expansions, meaning a period without a recession in our history. So when you combine that with the liquidity that's already being drained and tack on some more Fed rate hikes, I think the Fed will be very sensitive to the fact that, are we doing or asking too much? And if we see a big correction or a big move lower in stocks, I think they'll ease up on that right away, and they'll be quick to shift course. That could mean some good news for interest rates, though. And by the way, Fed rate hikes typically have been good to interest
Right.
rates. We know that, right? So,
Right.
so remember, there's two parts here. You've got the shorter end of the curve, you know, the 1 year, the 2 year Treasury, the bills that are monthly bills that come out, you know, the 3-month. And then you've got the longer end. You know, you've got the 30-year bond, the 10-year note. And what you've seen is quite a bit of compression, right? Because Fed rate hikes, if they continue, probably bring down the longer end of the curve, but they have to push up the shorter end.
Right.
As these two get closer together. You start to say, hey, do we get maybe an inverted yield curve? Now, we're still 75 basis points above that, but not too long ago it was 250 basis points, you know, a couple of years ago. So the trajectories for compression, if that gets inverted, it's a very reliable indicator for a recession. That's not something the Fed wants to bring on.
Right. Yeah, that would. Yeah, that wouldn't be good headlines for them. So let's look at their near term for us then. So we had a recent increase. You said tax reform kind of helped us out a little bit there. That it got people out of stocks and back into bonds a little bit. What about going forward this week for the guys? This week into next week.
It's an enormous week. It is an enormous week. So the Fed's going to meet on Wednesday. You're going to get ADP on Wednesday.
Okay.
You're going to get housing data from Case-Shiller. On Thursday, you're going to get the announcement probably that Powell's our Fed chair. There'll probably be a market reaction to that. And Friday, you've got the jobs report.
Wow,
so this week is like, if you like market volatility and market moves, this is the week for you.
This is your week.
Yeah, so I think that you've got to really be on guard. That's why you want to watch certain levels. Watch 2.385 on the 10-year Treasury note. If there's bond-friendly news, we can get way below that. Rates will get real attractive, but it can turn quickly. So watch that as your kind of that's your line there, that if you start to see us move above that, you don't want to let it get away from us. You want to lock more quickly as things get above that, and you want to float with a lot more confidence as we get further away from that 2.385 to the downside. So use that as your barometer. That will tell you how the market is reading the news that's coming out. But remember, you can get whipsawed because it can change quickly from day to day, right? You're going to get